Hello, and welcome to our Friday edition of CMS Forex News. I'm CMS market analyst Nick Nassad, and today is October 31st. We begin with a barrage of data from Japan to end the month. Household spending declined 2.3% in September compared to a year ago, the seventh consecutive month that spending has been negative. The figure did beat expectations of an even larger decline. In another release that beat forecasts, the unemployment rate fell to 4%. Consumer inflation for the country remains steady at an annual pace of 2.1%. CPI excluding food inched down to show a 2.3% gain, while inflation excluding both food and energy rose to 0.2%. In the Tokyo area, consumer inflation for October cooled more than expected, posting a 1.2% change. Both core measures eased as well. This may be a sign that the fall in commodity prices is filtering through to the retail level. It also gave the Bank of Japan some extra breathing room when they decided on interest rates. And in that meeting, for the first time in 7 years, the Bank of Japan lowered its benchmark interest rate, easing it 20 basis points to 0.30%. It's an attempt to try and react to the recessionary conditions in the economy and the loss of confidence in Japanese money markets. The chance of a move was anticipated throughout the week. Japanese markets slumped Friday after the rate cut, as the markets had expected perhaps an even bigger reduction. Other markets in Asia were mixed, as investors locked in profits following 3 days of solid gains. A similar thing can be said of the yen cross pairs. Here, the Aussie yen retreated from yesterday's high, receding to 63.10 in the European session, following an almost 1,200 pip rally during the rest of the week. In the New York session, the pair rose back above the 65 level as U.S. stocks performed well. Retail sales in Germany, Europe's largest economy, fell 2.3% in September, undershooting economists' forecasts as consumers cut back their spending in the face of the worsening economic outlook that comes as a result of the financial crisis. The 2.3% decrease was the biggest drop since May of 2007. In the Eurozone as a whole, annual inflation is expected to be 3.2% in October, according to the flash estimate from Eurostat. It was 3.6% in September. Slowing inflation will give the European Central Bank more room to cut rates as it focuses on getting the economy growing again. The Eurozone unemployment rate remained at 7.5%. After falling late yesterday and in the Asian session, the Euro-Swiss franc pair rallied 250 pips from its intraday low near 1.4540. After falling on Monday, the return of risk appetite has brought the pair back above its start for the week near the 1.48 area. In the U.S., consumer spending was down 0.3% in September, which reinforces yesterday's GDP data, which showed consumers scaling back their purchases during this time of economic uncertainty. September's result was the weakest in 4 years and caps the weakest quarter in spending in 3 decades. Consumers are facing increased unemployment, high food and fuel costs, and falling housing prices, which has crimped spending. In addition, a collapse in lending and sentiment as a result of the financial turmoil may spell further cutbacks in spending going forward. Incomes grew 0.2% in September, a slower pace compared to the downwardly revised 0.4% seen in August. The Chicago PMI measure of business activity fell to its lowest level since the recession of 2001. Subgauges for production and new orders plummeted, bringing the overall index down to 37.8 for October, down from 56.7 in September. The UMich Index of Consumer Sentiment posted a 57.6 in October, a record 12.7-point drop from the 70.3 seen in September. The data suggests the drop in consumer spending will continue. The euro-dollar continued its retreat from its high this week near 1.33. After a strong rally during the middle of the week, the pairs retraced to the 61.8% level around 1.27. This week showed markets returning to some of their pre-credit crisis ways, though how things go next week will reveal whether the recent rally was a correction or perhaps the start of a new trend. As we mentioned before, U.S. stocks did well today, with the Dow Jones Index climbing 170 points in early New York afternoon. The positive sentiment in U.S. markets helped the dollar pair its overnight losses to the yen, and this pair retested resistance at 99.10. In Canada, GDP growth for the month of August declined 0.3%, partly reversing the 0.7% gain seen in July. Wholesale trade, manufacturing, and the energy sector, which were the main contributors to the July increase, all retreated in August. The US dollar Canadian dollar rose overnight, but then paired those gains in a 400 pip fall in New York trading. That brought the pair back down to the 1.1950 area, which is where the pair fell to in yesterday after this week's 1,000 pip move in favor of the loonie. Next week starts with data on inflation, housing prices, and retail sales from Australia. That will be followed Monday by manufacturing activity data from the UK, Eurozone, and the US, and the interest rate decision by the Reserve Bank of Australia. The rest of the week brings important releases as well. The latter half of the week will see interest rate decisions from the Bank of England and the ECB, along with the US non-farm employment change on Friday. And of course, on Tuesday, the US holds its presidential election. And that wraps up this week in the Forex markets. Thank you for joining us here at CMSFX.com. Make sure to grab our new version of our trading software, VT Trader 2. Have a great weekend and happy Halloween.